Often what we see is just what others want us to see. Gold has not made new highs in many months. It peaked last year at $2,067 on the 6th of August. The 7-month down leg since then of more than 18% has been deep enough and long enough that some commentators are now saying that the bull market has turned into a bear market for gold. Losing faith is understandable because falling prices feel bad. But this week, we want to show that current prices may not reflect reality. We'll review the story of Archegos Capital Management, which proved that prices often are false signals, a picture painted by others who have their own agenda. Then we can relate the story back to gold and silver by making the point that 7 months of a down leg means nothing. Archegos is something almost no one heard of until last week. Its founder has had past run-ins with stock market regulators for breaking the rules. Regardless, giant global banks like Mitsubishi, Credit Suisse, and Nomura loaned billions of dollars to Archegos. Importantly, those loans appear to have been on the scale of about 10 to 1. For example, if Archegos started with $1 billion, they then borrowed $10 billion against that $1 billion, making a total of $11 billion available for investing. So it's basically a hedge fund. But since all money comes from the owner, it's called a family office. Apparently, Archegos' investment strategy was to keep pouring money into the same few stocks so that the resultant rising price action would draw other investors into those same stocks at higher prices. Presumably, Archegos intended to spark a rally and then sell into that rally near the top for a nice profit. Today's main lesson is price action does not always tell the truth. Instead of selling at the top, Archegos suffered a huge margin call for many billions of dollars. Apparently, they'd borrowed so much money from so many different banks that once all the banks came to realize the size of the debt, faith in Archegos was lost. The giant banks will all lose billions, and Archegos itself may even have the original billion wiped out. Thus, today's second lesson is banks have a simple business model. They rent out umbrellas on sunny days, but need umbrellas back when it rains to keep themselves dry. Sometimes, as in the case with Archegos, they get stuck in the hurricane without any cover. For months on end, to an outsider, watching the upward progress of stocks bought by Archegos with borrowed money from major banks, there was no sign of trouble whatsoever. Many investors were enticed to buy shares by rising prices. Those investors now wish that they had not, as prices declined dramatically, as the scheme broke up, leaving banks to sell for whatever they could recoup. Until something broke, the price action was a beautiful picture painted by Archegos. Once the break happens, the reason for the break barely matters. That leverage goes into reverse. Here's another proof of the main lesson. It turned out that once the banks recognized that the rain was coming, they argued over the umbrella, as there was not enough to go around. Calling for a bailout early on, some of the banks tried to prevent all banks from selling shares so quickly that the beautiful rising price picture would be revealed as a forgery. So once again, we see that price action does not always tell the truth. Once that bailout conversation failed, it was each bank for themselves. To recap the story, what we see every day over a very long period of time can very easily be a picture painted for us by someone else who is not displaying the entire truth. Once the truth cannot be hidden, everyone, including sophisticated bankers, worry about themselves and themselves only. Now, let's apply the main lesson to gold, which has been falling for months. The picture painted certainly looks grim, yet as we learned in the Archegos story, maybe the picture is not the entire truth. Is there some levered investor whose method is betting against retail buyers that use stimulus checks to buy gold and silver? Nothing in the Archegos story confirms or denies this. If there is one, we'll not know until prices spike higher. We'll not know until it's too late for buying the metals. We will not know until after the global banks know. Given the Archegos story, should people sell metals because they've fallen in price for months? No. Maybe the Archegos story above raises a vital question. When central banks lower interest rates and ensure liquidity, who do those actions help the most?